All right, how do we handle return deposit items? A customer gives you a check, the check bounces, your bank reverses it. There's two things you need to do. First thing is you want to subtract it from your bank balance, and you do that by writing a check. Now, when you write the check, of course, you don't need to print it. I always use RDI, our return deposit item, RDI. And in fact, I have a line item set for it in the pay to the order of, RDI. Now, what happens is you want to put that to the chart of account of sales. This will lower sales. In this case, let's do a $4,000 figure. So $4,000. Check is bounced. I'm creating a check which subtracts it from my bank balance in the amount of $4,000. I would then hit save and close, which I'm not going to do in this example here. All right, second thing you do right away, you want to create an invoice charging back the client. Again, you have an item, return deposit item. Now this increases sales. You're creating a sales invoice. Now when you did the check, it lowered sales. You're creating the invoice. This increases sales, and you're doing it in the same amount, $4,000. Now by doing this, one nets out against the other. So if you were to look at a profit and loss statement, the bounced check and the charge net each other out. If at some point you never get reimbursed by the client, then you can make a credit or reverse it to lower sales because you never got reimbursed from the client. But that's not what we're assuming at this time. You want to create the invoice to the client, and it then goes back on the receivables, so you know you want to collect it from the client. Now, if this is a taxable sale, you would not charge the tax on this invoice. That's been done already on the original invoice. So at this point, it's just a dollar amount, and this really is the best way to handle it in QuickBooks.